Welcome to This Week in Money. I'm Jim Goddard. Today, Sprott USA Holdings President Reaugh talks about gold, silver, the U.S. dollar, uranium, oil, and NAFTA. He takes a look at the long-range prospects for the Canadian and U.S. economies. Wall Street's Wolf Richter delves into the automotive sector. Can the industry survive tariff wars? The make of a car is not always a way to tell where it was made. He also takes a look at interest rates and the real estate market. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Reaugh right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and planned for Canada this summer. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol AESDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Reaugh, President and CEO of Sprott USA Holdings. He's speaking to us from Vancouver. Rick, welcome back to This Week in Money.
Always a pleasure. Thank you.
Rick, the Sprott Symposium is returning to Vancouver this month. Can you tell us what's it all about and who's going to be there?
Yeah, I'm delighted to say that this is the 29th consecutive year that we or our predecessors, Agora Publishing, have hosted the Natural Resources Investment Symposium at the Fairmont Hotel Vancouver in downtown Vancouver. The conference takes place July 17th to 20th. This year we will have 80 vetted public company exhibitors. We'll have over 800 attendees. Uniquely, I think, in the case of our investment conference, first of all, it's all mining. You won't have to deal with any crypto. You won't have to deal, except on street corners, with any cannabis. And also uniquely, every exhibitor there has been vetted by Sprott. That isn't any guarantee that every stock will go up, but certainly every exhibitor there is well enough known to Sprott that we have invested in their shares in performance fee generating accounts. As to speakers, backed by popular demand, Jim Rickards, a real insider in the American economy, having been, as an example, chief counsel for long-term capital management, a firm that almost brought down the U.S. economy. David Stockman, director of the Office of Management and Budget during the Reagan years, returning probably for his 20th year, the iconic Doug Casey, Grant Williams, Jim Grant, as well as, industry spokespeople. The founder of Wheaton Precious Metals, as an example, Robert Friedland, Ross Beatty, Bob Quartermain. Bob Quartermain is not coming this year. But in addition to, of course, all the editors and gurus and pundits, Sprott always thinks it's important to establish one-on-one connections between investors and great entrepreneurs who have built billion-dollar-plus natural resource companies, so that the lessons that they learned in building those wonderful companies can be available to retail investors to help shape their own perceptions in mining and oil and gas investing.
Rick, do you think the world or the U.S. can be tariffed into recession right now?
I do. I believe that any sort of protectionist legislation makes everyone poorer. Certainly, if you are one of the few that are politically protected, it's good for you. But the ultimate loser in any protectionist scheme is the consumer, and the consumers are, of course, the largest but most diffuse audience in any system. So tariffs make the United States poorer, despite the protestations of Trump, and tariffs make Canada poorer, despite the protectionist instincts of the government in place.
Would it be better for governments not to put in retaliatory tariffs to the U.S. action?
Well, I, of course, believe it would be better for governments to disband, but that's a very different question. The political realities are that small groups of politically connected insiders always conspire to deprive consumers of access to markets. The Americans would argue that what they are doing is simply responding to a Canadian Canadian scheme of tariffs that has been in place for 30 years. And of course, the Canadians make retaliatory claims. The U.S. claims are, of course, advanced by a uniquely bellicose protectionist, Donald Trump. But the arguments that the Americans make with regards to government supports and, as an example, market structure support in the farming industry in Canada are not unfounded. The truth is that Trudeau is a more Canadian and more polite protectionist, but there is certainly no innocence on either side.
Rick, you just returned from the Mining Journal Conference in London. How was that show?
It was interesting. Interesting in many regards. There were some very high-quality speakers. I really enjoyed the conference, and of course its presence in London, which is the historic capital of mining finance, was good. It was useful for me, too, to observe the fact that it was an under-attended conference, which says something about interest in the sector among mining veterans, but also among generalist investors. I have found myself that one of the great informal gauges of value in the mining sector is the interest or lack of interest in high-quality conferences like this. Perversely, the limited attendance at this conference suggests to me that investments in the sector are efficacious because pricing is cheap. It also suggests, however, that if you're a momentum-oriented speculator, you'd want to be in some other sector. If you're value-oriented, mining's the place to be. If you're momentum-oriented, then you need to go into a sector that has over-attended rather than under-attended conferences.
How was the mood there towards junior resource stocks?
Given the paltry nature of the attendance, one of the things that you could say is that the interest in the juniors is low. I note, however, that the high-quality juniors are receiving funding in this market. There were complaints from the podium about the lack of funding, and then, of course, you see things like Cobalt 21, run by an extremely capable young team in a sector, admittedly, that's hotter than the rest of the sector, that's raised $880 million in the past 12 months. So when a startup junior is able to raise $880 million, one wonders about the claim of underfunding that comes from the rest of the sector.
Are we likely to see summer rallies in the stock market or commodity markets?
My own experience has been that bear markets are the authors of bull markets. And bull markets, conversely, are the authors of bear markets. Great bull markets always arise from the ashes of bear markets. One of the things that attracts me about the market that we're in is the fact that the commodity prices have held up fairly well in the last 18 months and have, in fact, outpaced resource equity markets. I have seen this circumstance twice before in my career, and in both circumstances, the equity markets played catch-up in fairly dramatic fashion. There's no guarantee, of course, that past is prologue. I'm not really a market commentator. I'm a credit analyst. I would only note that a circumstance where commodity prices stay strong, and hence producer cash flows stay strong, generally results in an equity uptick in the sector.
Gold and silver are still in their long-term trading ranges. Do you see gold and silver breaking out at some time soon?
I don't know. My experience has been that in normal circumstances, the most important determinant, not the only, but the most important determinant in gold prices are global faith in the U.S. dollar, particularly the U.S. dollar as expressed by the 10-year Treasury. Global faith in the U.S. dollar right now is very, very, very strong, perhaps as a consequence of weakness in other currencies. But the U.S. is also perceived as having positive real interest rates. So the dollar and the U.S. Treasury markets are very strong, and the victim of that strength is, of course, the gold market. We have talked on your show many times about whether the U.S. dollar deserves to be strong, particularly in absolute sense, where government policies will ultimately undermine a U.S. economic recovery, and also where the aggregate debt in the United States, particularly at the federal level, but also at the state and local levels, may serve in the future to undermine the strength in the U.S. dollar. I'm tempted to point people towards Doug Casey's old quote about the U.S. economy being the prettiest mare at the slaughterhouse. But I will say that as long as faith in the U.S. economy and strength in the U.S. dollar continues, it'll be hard on the gold market.
Does the U.S. dollar need to decline for gold and silver to move higher?
I believe so.
It looks like interest rates are going to keep rising. Is that good for gold and silver?
People say that the gold and silver price can't rise during a period of rising interest rates. I would respond that it's really a function to the reason that interest rates rise. If interest rates rise because of the investor's perception that they require a higher yield to compensate them for the depreciating purchasing power of a currency, then gold can do very well. When people tell me that the gold price can't rise in a rising interest rate environment, I remind them that I came into the investment business in the 1970s when the gold price rose from $35 an ounce to $850 an ounce, despite a six-fold increase in the prime interest rate and the yield on the U.S. 10-year Treasury. So gold can, in fact, increase in price, sometimes dramatically in a rising interest rate environment. The real determinant is the cause of the rise in the interest rate.
Does the Fed really set the interest rate, or is it the whole world market doing it for them?
I think in the near term, the Fed does have some control over interest rates. There is perversely, I believe, some faith on the part of markets that the Fed is an efficacious actor. I don't happen to believe that's true, but I inhabit the minority position. I think what happens is that investors and voters worldwide want to abdicate responsibility for their own financial future and want to believe that the big thinkers, the Fed, Trump, and Trudeau, are capable of stick-handling society's sort of savings and investment goals. I don't happen to believe that's true, but I think we're inhabiting an epoch where, despite lots of evidence to the contrary, people have faith in government and collective solutions.
Is that a misplaced faith?
I believe it's certainly a misplaced faith. I believe that government is the author of most of the problems in society rather than being the path to any solutions. But again, that's a private view.
Are you bullish on gold and silver juniors?
I am bullish on select gold and silver juniors. It's important to note that if you were to merge every public mining junior in the world into one company, that company would lose between $2 and $5 billion a year. So the sector taken in aggregate is valueless. That statement, however, hides the fact that the performance of the top 5% of issuers in the sector can be so spectacularly good that it lends credibility and sometimes even luster to the entire sector. The point of that for investors is to be extremely discriminating in your selection. There are teams in the sector, probably 40 worldwide, that have been serially successful. Warren Buffett famously says there are millions of people in the world that can play basketball, But if you want to win games, you got to hire some 7-footers on your team. And the truth is that there are probably 40 teams worldwide that are inhabited by 7-footers. Concentrating your investment efforts on those teams rather than spreading the money across the narrative of various stories in a sector that's destroyed so much capital is the key to success.
Are you bullish on other junior market sectors?
I am. I see a circumstance where, as an example, high-quality copper projects will do very, very well in the market. I believe that the uranium sector is in the process of a very slow turnaround, and pardon the pun, I see really explosive upside in the uranium juniors in the 1 to 2 year time frame, a time frame, unfortunately, that exceeds most speculators' patience. The truth is that the long-term bull market in resources is assured by the very ascent of man. The fact is that 2 billion people worldwide, the poorest people on the planet, are experiencing a gradual increase in their living standards. And when those people get more money, when they get the ability to consume more stuff, what they spend their money on is very commodity-centric, unlike the way rich people spend their money. They want to eat better. They want to live better. They want a better material standard of living. And that very tendency in and of itself ensures us a long-term bull market in commodities. I would suggest to you that the bull market, the overall bull market that we've enjoyed in commodities markets since really the year 2000, is a consequence of the urbanization and the emergence of some form of freer markets in China, led off, of course, by Deng Xiaoping, who said to become rich is glorious. And while the transformation of China occurs, the transformation of other economies, other poor economies, is still just beginning.
With China becoming a free enterprise economy, does that give them a better chance of eventually someday becoming a democracy?
I don't know the answer to that. That's a bigger question that I'm capable of answering. I wonder whether the countries that claim to be democracies, as an example, the one that I live in, are in fact truly democracies. The revelations as an example of Mr. Snowden with regards to U.S. government espionage and manipulation of information on its own constituency doesn't suggest that the United States itself is much less democratic than its people believe it to be.
Could uranium be replaced with thorium?
That's a technical question that's probably above my technical capabilities. What I will tell you is that people who have better access to information, technical information, are in the process of investing about $200 billion in power plants running on uranium, with a much, much, much smaller commitment, sub $5 billion, as I understand it, in the thorium sector. That would tell me anecdotally that the technical community is more attracted to uranium than thorium. But that's only an anecdotal response to your question.
We'll have more with Rick Reaugh next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic Engineer Gold Mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're chatting with Rick Ruhl, President and CEO of Sprott USA Holdings. Is the growth of electric vehicles and power storage dependent on the availability of the commodities used to make batteries?
To some degree, but I think what you're going to see is, depending on the market price of those commodities, increasing specialization and adaptation, fabricating efficiencies. So my own belief is that the march, particularly of distributed storage, which is to say battery technology, will continue to improve for a very, very, very long time, which is going to be good for everybody. Now, understand that the 20-year or 30-year time frame, the time frames I'm talking about, doesn't do anything to preclude temporary shortages. One example has been that we've seen a real strong upward move in the last 4 years in the lithium price, despite the fact that lithium is very, very available as a commodity. What happened was that demand for lithium exceeded in the near term the industry's investment in processing facilities necessary to extract natural lithium and make it into a viable lithium chemical. This will take place over time. Similarly, we're seeing a circumstance where demand for cobalt in the very near term has generated a tremendous price rise relative to the availability of cobalt. The cobalt market itself is, of course, constrained because about 65% of current supplies and 75% of supplies 5 or 6 years ago come from one political jurisdiction, Congo, which is, to say the least, a very challenged jurisdiction. But the truth is that markets work. The cure for high prices is always high prices, and the cure for low prices are low prices. If the cobalt price gets too high, fabrication technologies will emerge that will use less cobalt or will substitute other materials for cobalt. If the cobalt price stays reasonable, then utilization of cobalt will continue to increase dramatically. It's important for speculators to understand that over time, markets always work.
President Trump said he doesn't want NAFTA to be negotiated now until after the U.S. midterm elections. Is there a message there for people who are traders?
I don't know. I think it's a political message. I would note, by the way, that NAFTA is not a free trade agreement. If you and I were to have a free trade agreement, it could be written in one paragraph on one piece of paper. It could say there will be no legislative or other restrictions on the exchange of goods and services between free people. Stop. NAFTA has 3,600 pages. Every one of those pages seeks to restrict and channel voluntary trade. It is not a free trade agreement. It's a political managed trade agreement. Whether or not the current agreement is better than the one that follows is really a function of the political process.
Canada doesn't even have internal free trade. You're not allowed to buy big quantities of BC beer and take them into Alberta, for example.
Or if you are an Alberta resident, you are discriminated against in property taxes in various BC markets. I couldn't agree with you more.
Yeah. Are you bullish on America?
Long term, I'm very bullish on America, despite everything that's wrong with the country. And there are a myriad of things wrong with the country, starting with the political leadership. The truth is that America is still an amazingly innovative society. We still have the vestiges in the United States of the culture of freedom that made us a very wealthy society. The United States, despite all its faults, is still a place where 5 or 6 young people, mercifully now often immigrants, commandeer a garage in Silicon Valley, and out pops Google, or out pops Facebook, or out pops Amazon. It is truly still an amazing place where financiers are willing to back good ideas, and those ideas with minimal capital backing generate businesses that literally change the world and generate tens or hundreds of billions of dollars of wealth. So long term, I'm still extremely bullish on the United States, despite, not because of, the political leadership.
Do governments really need to support the high-tech sector, or does it look after itself?
I think government constrains the high-tech sector. The best thing that government could possibly do for the high-tech sector is forget how to even spell it. It is amusing to me, the spectacle of the U.S. Congress grilling the chief executive officer of Facebook over privacy, when the Snowden tapes revealed privacy violations, in fact espionage by the U.S. government against its citizenry, in a sort of quantum that made the Facebook efforts look absolutely paltry. The best thing that could happen for technology in the United States would be for the U.S. government to forget that technology existed. And, oh, by the way, quit extorting so much of the economic return from technology away from technology in the form of taxation.
Are you bullish on Canada?
I am bullish on Canada. The Canadian society is similarly innovative and much more tolerant than the U.S. society. Canada is stuck in a strange place right now, particularly the province of British Columbia, stuck between a highly intelligent immigration policy, particularly for high-skilled immigrants, stuck between that and the xenophobic, protectionist, racist legislation fronted by the BC government and, importantly, by Vancouver City Council. It's very odd being in Vancouver, a place that regards itself as extremely progressive, which at the same time promotes the xenophobic property tax legislation, anti-immigrant, anti-Chinese legislation that it does. It's hugely ironic to me that the jurisdiction in North America that has gone the furthest in promoting the Trump wall, the xenophobic protectionist wall, is the city of Vancouver, which has built a fiscal wall around itself by racist, protectionist property tax legislation. It's very odd to me that Canada has this wonderful juxtaposition between being a free and open country, except if you manage to achieve and thereby compete with Canadians who have been less able to achieve.
We'll have more with Rick Reaugh next on This Week in Money.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange symbol CYP, the Pink's CYDVF, and on Frankfurt C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Rick Reaugh. Rick, are you bullish on base metal juniors?
Select base metals juniors, absolutely. You know, we at Sprott had the extraordinary good fortune to be the largest shareholders in Reservoir Minerals, which discovered, of course, a copper-dominant deposit in Serbia, which was then sold to Nevsun, and was so attractive that Nevsun is now subject to a takeover battle with the Lundins. We were also lucky enough to be large shareholders in Mariana Resources, which was of course taken over by Sandstorm. And of course, we have been very large shareholders in Ivanhoe Mines, which has been driven by copper and zinc deposits, albeit in a troubled country, Congo. Base metals markets traditionally have been less sexy than gold markets. But the truth is that high-quality mines, almost irrespective of the commodity produced, are great sources of wealth over time.
A bill legalizing hemp just passed. Could this affect the softwood lumber industry?
I don't know the answer to that. That's above my pay grade. I suspect that some of the properties of hemp and its very long fibers could, in fact, be very useful in the pulp and paper business. The truth is, being here in Vancouver, the part of hemp that seems to attract people is the cannabis side of the hemp business, which of course has other applications.
Well, medicinal, the FDA in the U.S. has approved a drug made from cannabis. Does that open the door for more legalization in the U.S.?
I hope so. I've believed for 20 years that I could cut crime in the United States by 50% with the simple expedient of making less stuff illegal. Marijuana being an absolutely classic example of that. The fact that for the last 50 years, we have chosen to incarcerate young people who, of their own free will, used a substance which is probably no more dangerous than alcohol, sending them into incarceration, which is basically a finishing school for criminals, is in and of itself criminal stupidity. The Attorney General of the United States, I think, is clearly out of step with the will of the American people, but I think he's also out of step with the changing of society with regards to personal self-determination.
President Trump is said to be making changes to Dodd-Frank. What changes would you like to see to Dodd-Frank?
I'd like to eliminate it. Dodd-Frank was put in place really as a consequence of the Enron affair. Now, Enron was a fraud, and fraud was already illegal before Enron and Dodd-Frank. What you had in Enron was a regulatory failing, and ironically, the response to the regulatory failing was to increase the budget of the failed regulators and change the nature of legislation. Warren Buffett, who is certainly no fan of free markets, has noted in fact, that Enron itself cost American investors $80 billion. And the change in reporting standards necessitated by Dodd-Frank penalizes investors with excess costs that exceed $100 billion a year. So we have cost ourselves as a society $100 billion a year as a consequence of a one-off event that caused us $80 billion. It is amazing that the United States is as prosperous as it is with the level of stupidity sort of put forward by the American political and regulatory culture.
It looks like President Trump is working on getting Iran under control. The U.S. has asked its allies not to buy any Iranian oil. First of all, my question is, does the U.S. have any allies left considering all these tariffs?
I think that's a wonderful question. That question brings up so many potential responses. While I'm not an expert in foreign affairs, and I certainly wouldn't want to defend the Iranian administration's actions against their own citizenry, I would point out that American troops are stationed in many more countries than Iranian troops are stationed in. So the argument that the United States is a force for peace, whereas the Iranians are expansive, is an argument that has trouble standing on the facts. With regards to America's soft power on a global basis, I think America's soft power on a global basis is subsiding very rapidly. It's subsiding partly as a consequence of Trump's bellicose, how would you say, advancements of an agenda which is not in the United States' interest. It's also, it meaning American influence, is also receding because America's percentage of global GDP is decreasing. The United States was the strongest diplomatic force in the world when it was the strongest economy in the world. And the expansionist nature of the United States government during the period of time of really John Kennedy forward has meant that the decline in American prestige is largely a self-inflicted wound.
If they do manage to get oil restrictions on Iran, what would that do for the global oil market?
I think that's probably less important with regards to the global oil market than two things. One is whether or not we slip into a global recession. You know, we have been recession-free in this economy really since 2009 or 2010. So we've had an 8-year synchronized expansion worldwide. I'm not an economist, but I suspect after 8 years, the expansion may be getting long of tooth. The second reason that we've seen an advance in oil prices over the last few years has been, again, that markets work. During the period of very low oil prices, the $40 and $50 oil prices that we saw 3 or 4 years ago, the oil industry itself was guilty of constraining sustaining capital investments. And in some countries, I'm thinking Indonesia, Peru, Venezuela, and Mexico, that lack of sustaining capital investment has really constrained, perhaps permanently, production. The freezing of Iranian oil, to the extent that it's successful, and it will be only of limited success, is less important than the decrease in Mexican production from Campeche or Venezuelan production. The combined production declines from those two oil producers as a consequence of lack of sustaining capital investments exceeds 4 million barrels a day.
Did the Canadian government have no other choice than to take over the Kinder Morgan pipeline between Edmonton and Greater Vancouver?
Well, the one other choice would have been to adhere to the rule of law in Canada. That's always politically inappropriate, I guess. And understand, I'm American, not Canadian, so my expertise on this is limited. It would always seem to be more expedient for politicians to spend taxpayers' money than to spend their own political capital. But the truth is, there are so many easy criticisms in the United States that I'll defer, for the most part, about criticizing Canadian policies. I try and restrict myself to criticizing societies where I'm a taxpayer. Now, given the level of property taxes that I pay in British Columbia and Vancouver, I feel that I have bought and paid for my rights to criticize those jurisdictions.
Is President Trump different from the other presidents in recent memory?
I think President Trump is different than the other presidents. He has, to the chagrin of many people, done what he said he was going to do, which is highly unlikely, or highly unusual, in American politics. Much of what he has done is something that angers people. I think his political style is certainly different, too, and in that regard I probably side with his critics. But I think he is unique in American politics. He is a genuine populist, and like many genuine populists, he angers profoundly the community that disagrees with him. One thing that he has done in the United States, which I think is reasonably useful, is that he has delayed the replacement of retiring civil servants. And so although he has been unable to get through regulatory reform in the United States by statute, what he has been able to do is underfund and understaff the regulators. So he has done a reasonably good job in deregulation, albeit in stealth fashion.
Is the U.S. as divided as the media portrays it?
The United States is absolutely as divided as the media portrays it, perhaps more divided than the media portrays it. There certainly are, and have been for a substantial amount of time, cultural wars in the United States. There are also underreported class divisions in the United States and regional divisions in the United States. There was a supposition in the United States that existed for a very long time that was very healthy, that the job of society was simply to provide a sort of level playing field. Now, the reality in the United States is that we didn't provide that level playing field. As an example, we were, as a society, resolutely racist. But the ethos was that the job, if you will, of American society was to provide access to upward mobility, and that it was the responsibility of the individual to get ahead. The United States has become more and more and more political, and the idea that you have access to benefit through politics rather than through your own efforts, I think, is what has led to the polarization of the United States. The idea that people derive or should derive benefit from society, from the Commonwealth, rather than from their own initiatives.
We'll have more with Rick Ruhle next on This Week in Money.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Rick Ruhle, President and CEO of Sprott USA. Rick, when you're taking a look at the economies of Canada and the U.S., are there any particular sectors that you're really bullish on?
Any sectors I'm really bullish on? No, I'm a little cautious. I feel moderately bullish about the sector I'm most familiar with, of course, which is the natural resource sector, as a consequence of, as you have noted, the underperformance of the shares relative to the performance of commodities prices. In the United States, I'm probably moderately bullish towards the smaller community banking sectors, and the smaller insurance sector, but it's such a small sector that it's probably not an investment play. I would note that although I am not an economist, that we have had a sort of an 8-year run since we have had any form of economic slowdown. I would note also that at least part of that run has probably been fueled by artificially low interest rates and excessive liquidity in the system. To the extent that the government in the United States and Canada were to make liquidity less artificially available, and to the extent that interest rates rose to what I suspect would be their market rate, my suspicion is that that would be difficult both for the economy in the near term and also for equity markets.
Last time we had high gasoline prices, a recession followed. Gas prices are hitting new highs, while oil is nowhere near new highs. What does this mean overall for the economy?
Well, it functions as a form of a tax. It leaves less money left over for other things. It's important to note the disconnect that you noted between gasoline prices and the oil price. We have an artificial constraint on refining capacity across North America as a consequence of NIMBYism. That is exacerbated by the increasing social take, which is a different way of saying increasing taxation on gasoline prices. It's ironic to me when I see gasoline prices in the lower mainland of British Columbia, which are, as I understand it, the highest in North America. That in a petroleum exporting country is extremely ironic. In British Columbia, particularly in the lower mainland, of course, there's a constraint on refining capacity. At the same time, there are extraordinary fiscal tariffs. It's ironic, too, in British Columbia, the political constraint on the Trans Mountain Pipeline, when there are other pipeline products that are bringing, pipelines, that are expanding, that are bringing refined product, ironically, from the United States back into British Columbia. The high gasoline prices that we're seeing in North America, but particularly in British Columbia, are a consequence of political failings, some of them deliberate.
How can people find out more about Sprott?
I would love it if people in Canada went to www.sprott.com. Investors in junior mining, which is what I'm particularly well known for, might go to our website, which is www.sprottglobal.com. And any residents of Vancouver, which I suspect many of your listeners are, might also want to consider attending the Sprott Vancouver Natural Resources Investment Symposium, July 17th through 20th at the Fairmont Hotel, Vancouver. In its 29th year, one of the finest natural resources investment symposiums in the world, and probably the single finest venue for understanding investing in the small cap exploration sector in Canada.
Rick, thank you so much for being on This Week in Money.
Always a pleasure. Thank you for the opportunity.
My guest has been Rick Reaugh, President and CEO of Sprott USA Holdings. He was speaking to us from Vancouver. Coming up from San Francisco, Wolf Street's Wolf Richter, next on This Week in Money.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Riaugh shear zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Wolf Richter, founder of wolfstreet.com. He's speaking to us from San Francisco. Wolf, welcome back to This Week in Money, and I hope you had a great July 4th.
Thanks for having me back, Jim. Yes, we had a wonderful July 4th.
Wolf, does the auto industry look like it's worried about tariffs?
Yes. The auto industry in the United States is dependent on imports, and that is that ranges from fully assembled vehicles to components that go into vehicles that are assembled in the United States, and that is valid for all automakers, whether it's American brands or whether it's foreign brands. And all global automakers have large plants in the United States. So they're assembling a large number of vehicles here. Honda is probably on the forefront. It assembles not only cars but also components in the United States. And among import brands, it's really the most American brand that we have. and some of its models have up to 75% of U.S. content in them, which is very high, and beats a number of American brands that are assembled in the United States. So it varies across the industry, but Ford imports about 20% of its vehicles into the United States. GM imports about 30%. Most of the trucks are made in the United States, but most of the cars are made elsewhere. So this is a very complicated issue for the auto industry. The problem is for the industry that they're charging absolutely the maximum price for the vehicles that the market will bear. And so they can't raise prices. So if there are tariffs on imports, whether that's components, assembled vehicles, those tariffs cannot be passed on to consumers because consumers are already striking at current prices, and manufacturers have to offer huge incentives to keep the volume up. And there are many manufacturers that assemble their vehicles in the United States, so they are not hit by the for those models. You know, they're not hit by the tariffs. So if GM wants to slap a $5,000 surcharge because of tariffs onto a Chevy, it would have to compete with a Honda that is not imported and doesn't get the surcharge. And, you know, buyers aren't going to go for that. So manufacturers know that. So in terms of the market, what it will mean is that profit margins will shrink for the industry. And the industry will react to that. So the industry reaction generally will be to bring production back to the United States, and at least some more production. And so there'll be fewer tariffs. And that will be the goal. That's the goal of those tariffs, to bring production back to the United States. And that's particularly the case in terms of components with China and Mexico. In terms of assembled vehicles, it's Mexico and to some extent Canada. And then, of course, Europe, which imports a lot of, from where we import a lot of vehicles to the United States. And so, the industry is in uproar over this, in part because it knows it cannot pass on these tariffs. They come out of the profit margin, and the supply chains will have to be restructured. Now, you can't restructure a supply chain from one day to the next. It takes years. It takes a long time to do that. But the tariffs are supposed to encourage manufacturers to do precisely that. And we've got to keep something in mind here. There are probably no more balanced trade relationships that the United States has than the one with Canada. Trade between Canada and the United States is essentially balanced. I mean, that is a great trade relationship, and there are problems, particular problems on both sides about particular issues, and the normal quarrels that you have as trading partners, and that we had in the past, that we will have in the future. That will, we'll always have those. But in terms of overall trade, that relationship is very balanced and very solid and very good, and it shouldn't be rattled. But the trade relationship that the U.S. has with China is way out of kilt, and the same thing with the trade relationship with Germany and also with Mexico. And that's not the fault of those countries. It's the fault of corporate America that has pushed production out to these countries. And after the financial crisis, the U.S. component industry, which was owned at one point by the manufacturers, so by GM and Ford and Chrysler, they all went bankrupt, and the component makers. And when they came out of bankruptcy, they wandered off to China. They set up design centers in China. They started manufacturing in China. So a big part of the component industry in the United States walked off to China based on corporate decisions made in the United States, and in Mexico too. And so the component industry went where the cheap labor is, and where there are very few environmental controls, where it's cheaper to manufacture, and that has exacerbated the trade deficit that the United States has with China and with Mexico. In Europe, it's a somewhat different situation, and it's not necessarily cheap labor there. I mean, there are other issues, including much higher tariffs on vehicles that are exported from the United States to Europe than imported. The European tariffs on vehicles are 10% on cars in the United States, and that's mostly what what we import here. It's 2% for the United States. SUVs too. So it's an unbalanced trade, and it needs to be addressed. It needs to be looked at. And the car industry is just in the middle of it now because it imports so much, and it also, the global supply chains are so complex now, and so much of that manufacturing has gone out of the United States to China, Mexico over the last 10 years, that it is really, and when you look at U.S. brands, how much, the components are actually made in the United States and what is made in China and Mexico. It is astounding what has happened in recent years. So, this needs to be addressed, and we may not agree with how it is being addressed, and we have to be really careful to not cause major international economic problems with this. But the way that tariffs work, it's a tax. It's like a sin tax on alcohol or on sugar or on cigarettes. You impose taxes on behavior, or the government imposes taxes on behavior it doesn't necessarily want to encourage, and then the people that pay those taxes change the behavior, so they smoke less or they drink less, or if they don't want to smoke less and if they don't want to drink less, they just have to pay more. And for manufacturers, it's the same thing. It's a sort of a sin tax on imports, and the industry will react. It's a guarantee. If those tariffs become reality, which they have yet, it's a long ways off. Right now everything's just talk. But those auto import taxes, tariffs, when they become reality, the industry will react by changing its supply chains, and that will be expensive for the industry, but the industry has to protect its profit margins. It simply, the industry doesn't like to do this, but if tariffs force the industry to do that, that will be a good outcome. The United States cannot constantly every year after year, increase its trade deficit. At some point, the economy is just going to implode on the imbalances. You can't do that. And it needs to be addressed. It should have been addressed 20 years ago. And it's finally getting addressed. It rattles a lot of countries, countries have gotten dependent on their trade surpluses with the United States. So they're going to squeal, and corporate America is squealing the loudest. And these automakers their squealing is deafening. But it's their decisions that led to this, and I think they need to relook at the supply chains.
Is automobile financing becoming harder to get?
In general, no. The banks are still willing to lend. Captive finance companies are still willing to lend at fairly low rates. Credit standards haven't really tightened, except for subprime rated customers. And there we have seen a significant tightening. We have seen subprime auto loans default in very large numbers after years of loose lending standards. And that's less a problem with big banks, even though default rates have gone up there too. But that's a real problem with smaller banks that have gotten very, very aggressive in that sector. And so for subprime rated customers with spotty income records and buying a car that's too expensive for what they can afford, things are getting more difficult. That kind of buyer is having trouble financing a new vehicle. They can finance something, but they probably have to step down something cheaper, used vehicle. Maybe they have to save a little more money before they try again, those kind of things. So, the really loosey-goosey subprime financing that we saw in 2014, 15, and 16, that is being tightened up because the default rates are just astronomical right now from those loans that were made a year or two ago.
Pickup trucks and large SUVs guzzle more gas, yet are overall probably safer vehicles versus smaller, fuel-efficient cars. What do you drive and why?
Well, I know what we should be driving. Personally, I live in San Francisco, so I walk everywhere I go, and my wife takes the car. She works in Silicon Valley, so she drives. But what we should have done is when we bought the car is buy something safe and economical. And we bought something that is neither. It's neither an SUV, it's a car, and it's a powerful car, and it's a gas guzzler. So, we bought it new, 11 years ago, and it's in perfect shape. There's no reason to get rid of it. And at that time, I still had a lot of passion for performance driving, which, in the meantime, I have completely lost. I really don't care about it at all anymore. So it was a very unreasonable thing to do. And I'm probably, in that respect, very typical for, the car buyer in that we don't make, decisions based exclusively, on logical factors. We don't look at the safety record. We don't look at the fuel economy and make those the deciding factors. We're kind of aware of it, but car buying is still an emotional act, and we fall in love with it. We want it. And there are people who drive pickups, for example, that live in cities. They don't ever need a pickup. They just love driving it, and it's great. And the decision is made not by logical factors, but it's made because of emotional factors. You just like the vehicle. You want to be proud of it. You want to enjoy driving it. You want to be comfortable in it. You like the image that it projects. Those kinds of things. Those are really the important factors in buying a car. We may refuse to accept that. We may say, I look at all the things and I shop around and I look at all the data and all the specs and I make a decision based on that, and then we go shopping and then we fall in love and that's what we buy. And that's how car buying, how the industry approaches this. That's how the advertisements are geared that way. It's a big, important purchase, and emotions play a very large role in it. And that's how we make decisions. Now, large vehicles, especially those with frame rails, they're sturdier, they're heavier, they're sturdier. So, they're somewhat safer for, the passengers, but they also do a lot more damage to the other vehicle that they hit. So when they collide with a smaller vehicle, the chances of survival are different in both vehicles. So the smaller vehicle will be damaged much more than the larger vehicle. When two large vehicles collide, they do a lot of damage to each other, and it's more balanced. Now, pickup trucks in particular, but also large SUVs, they're more involved in single vehicle accidents. So, going down a country road and flipping over and killing the passengers inside than cars are. So this is one category where they're more dangerous, and that happens quite a bit. But in terms of collisions with another vehicle, obviously a large vehicle protects the passengers more and does a lot more damage to the smaller vehicle. I mean, they're very aggressive. Larger vehicles are very aggressive on cars. The bumpers in the wrong place, and they have a lot more mass and a lot more metal, and it's an unequal situation. At the same time, that's not how I make my decisions. That's a logical thing, and I know the probability of survival are greater in the tank than there are in the car, but that ultimately is not the deciding factor. And fuel economy might be a deciding factor when you buy a car and gasoline is $6 or $7 a gallon in the United States, or back 10 years ago when it was $5 a gallon. In other countries, we've lived in Europe, we're way back when it was $2.50 in the United States, it was $7, $8 in Europe. A gallon, you have to convert it to liters and stuff, but it is very expensive over there. And so people are a little bit more conscious of fuel economy when gasoline prices are very high. But in the United States, they're fairly low still. They've come up, but they're still fairly low. And so right now, I think the decision-making process has other priorities than fuel costs. Now, this changes, So and I don't know what the next level is. In the past, in the last, the last oil boom that we have, when gasoline hit $5, that kind of impacted the decision making, and that was 10 years ago. So next time around, when this happens, it won't be $5. And the $5 average gasoline cost. That's that means it's much higher in California than that. Next time it may be $6 or $7 a gallon, before that really becomes a factor. And by then, possibly, electric vehicles will be, more competitively priced, and that will be a big boon for the EV industry, when gasoline prices jump like that. And then it's no longer an issue of, truck versus car, but it may be an issue of, internal combustion engine versus electric, and it could be a pickup and an SUV that has an electric powertrain. So I think if we get another price burst that takes us to the next level, I think the decision making will be between electric and an internal combustion engine versus pickup and car.
We'll have more with Wolf Richter next on This Week in Money.
Vatic Ventures Corp. is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Vatic's management has extensive potash exploration and development experience in Thailand. Vatic will have marketing advantage compared to Western producers. Drill program commences this spring. Vatic trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, vaticventures.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Wolf Richter. Wolf, if you were in the market for a vehicle today, would you take advantage of the new vehicle incentives offered by dealers and manufacturers, or would you look for a late model used vehicle with low mileage?
Well, financially, I think it's always advantageous to buy a late model vehicle if you find one that's in really good shape and that's not overpriced. I mean, that's the key. The reason being that when you buy a new vehicle and you drive it over the curb and you get a title for it, it becomes a used vehicle at that moment. And it doesn't matter what the mileage is. There may be 3 miles on it, but it's now a used vehicle. And if you try to sell it, you have to sell it as a used vehicle, and there'll be thousands of dollar difference between a new vehicle and the new used vehicle. So, I mean, that's the big thing that happens right up front. New vehicles depreciate very, very rapidly during the first year, and then they slow down. When you buy a late model used vehicle, you avoid that first year plunge, and so you skip that part. At the same time, you don't know really what that vehicle has been through. So, I've always bought new vehicles because I keep them forever and, take care of them. And so I know the maintenance record of the vehicle. I know what it has been through. And if you keep it for a long time, it averages out and doesn't make a huge difference. But if you want to trade every 2 or 3 years, every 4 years, that that plunge of the first year in value is a big thing. And so from a financial point of view, if you don't own the vehicle for a very, very long time, it makes a lot of sense to buy a late model used vehicle. But then, there's more uncertainty too, and a little bit more lack of knowledge about what the vehicle has been through, and you miss out on this feeling of a new vehicle. Again, this is an emotional thing. So for other reasons, people might prefer a new vehicle. And personally, I don't know that I will buy a used vehicle because of our record of just owning these vehicles for so long that it really doesn't matter that much. And I'd like to have control over the maintenance of the vehicle at all time, and I like to know what it has been through. And so that's the other side. So there's really two ways of looking at it. And if everybody bought used vehicles, those prices would be inflated, and then it wouldn't make economic sense to buy them because the market would be too hot, and you'd be better off buying a new vehicle. So it always balances out, So there have to be buyers for both new and used. And the used vehicle market is a lot larger than the new vehicle market in terms of numbers of transactions per year. So it's a very liquid market. The pricing is very competitive. It fluctuates quite a bit depending on the market and the locality. There's a huge wholesale market for it. So this is a very well honed market that generally functions like a market should. On the new vehicle side, it is very different. This is less of a market. The manufacturers control the pricing. When vehicles don't sell, they add incentives to try to get them to sell. So this is a different dynamic. But, it's a decision people have to make, and for financial reasons, I think it's better to buy late model used, but there are other reasons, for which it might be better to buy a new vehicle.
Are the big auto manufacturers transforming their fleets to electric vehicles?
We just, saw the announcements, today and in prior days, that, the truck manufacturing branch, so the heavy truck manufacturing branch of Daimler, is, putting out a whole line of trucks that are based on electric powertrains, and delivery trucks and, trucks for drayage and big heavy Class A trucks, and, not necessarily for long haul, transportation, but for urban driving. And that's the key, I think. Electric vehicles are suitable, and very competitive for urban driving. And, that's delivery and it's personal transportation, for commuting. They're ideal for that. That's where a internal combustion engine is much more inefficient. And in that respect, I think, EVs will have the upper hand. And all automakers are aware of that. And so they're all building, models. They either already have them on the road or, they will soon have them. But none of them, are promoting them aggressively because batteries are still too expensive and it's still hard to make money with EVs. So as they're waiting for battery prices to come down and as battery, performance gets better, and that's been happening year after year, they're testing these vehicles, so to speak. They're building a few thousand of them every year, and a few tens of thousands, really small scale for a company like GM. I mean, when they're selling 20 or 30,000 EVs a year, that's peanuts for them. But it gives them an opportunity to test the vehicles, to get feedback from the customers, to build up the infrastructure for manufacturing these vehicles, and it allows them to train the dealers in EVs and the maintenance of them. It's a long process, and they have established service departments and service procedures. It needs to be incorporated, so it's all pretty complex. And so they're starting slow. Profitability in selling EVs is still not there, so nobody really wants to go out and lose a bunch of money by pushing them. They're not really advertising them aggressively. So, yeah, they're all there. They're all building them and designing them and expanding the models, but they're not quite ready yet for prime time. And but they will be ready. So as soon as battery technology comes down to where you can competitively price an EV without incentives compared to an internal combustion engine, you will see hundreds and thousands of these vehicles being built and marketed and advertised and promoted, and they'll have incentives like other cars, but that's not happening yet. We're pretty far away from that. At this point, they're all trying to prepare for that moment. And I don't think there's a manufacturer out there that doubts that EVs will play a major role in the portfolio of vehicles out there. And it's not going to be that they're going to replace entirely internal combustion engine vehicles. It's just going to be an option that customers can choose from, and so they can buy this type or that type of vehicle. And it's something that I think manufacturers want to be ready for when time comes to sell them, that they can massively produce them and put them out and can service them, can take care of the customers in every aspect, and have the dealers trained to deal with those vehicles.
Do you think self-driving cars are going to be viable in the near future?
Near future. Okay. Near future, 6 months, a year, 2 years, no. I mean, they're out there. There are prototypes out there, thousands of them. They're testing them. And they're making a lot of progress with them. And they're testing delivery vehicles, self-driving delivery vehicles, but that technology is incredibly complex and up to this point very, very expensive. These are prototypes, so these are all handmade stuff a lot of times. And so for a vehicle to be a mass-produced vehicle, the cost has to be competitive. So for a delivery service, for example, the cost of a vehicle also includes the driver. And so it's if you invest in a self-driving vehicle, and you can save the cost of the driver, that makes sense. But for a private individual, unless you're very wealthy and you have a driver, for most people that don't have a driver, and unless they really hate to drive, that extra cost, may be prohibitive. So, in terms of consumers buying self-driving vehicles, I think that will be the last segment in that transition. I think the first segment will be delivery vehicles, taxi type services, and that's not in the near future either. So that's I think that's where the priority lies right now. It's not consumer vehicles, but vehicles for fleets, and I think even the progress is rapid and huge and amazing, compared to where we were 5 years ago. But I still think it's a few years away. Yeah, interest rates are very important in the real estate market, especially in an environment that has seen declining interest rates and very low interest rates for over decades. And so the entire markets are geared toward having very low mortgage rates. And now that they're gradually and very unevenly heading higher, and they shot up earlier this year, and recently they ticked down a little bit, and that's how they do it. They bounce up and down, but now the trend is higher, and this raises the cost of buying a house if you finance it, which most people do. If you have a adjustable rate mortgage or variable rate mortgages, as most people do in Canada, for example, it also raises the cost of owning a house that you bought years ago. And that is not the case in the United States, where the predominant mortgages are fixed rate. And so if you bought your house 5 years ago, your mortgage payment will not change if it was a 30-year fixed rate mortgage, your mortgage rate will not change, and your mortgage payment will not change until the house is paid off. And so those are the two things, and this causes all kinds of problems because home prices are so inflated in so many markets that it is very difficult to expect buyers to increase their spending on a monthly basis for a home, and that's what higher mortgage rate would imply, that you would have to buy the same kind of house, you'd have to pay more money every month, and people are already stretched. So what they will do is they will try to step down, buy less house, and or wait. Or they can't afford it at all. A whole group of buyers will be cut out of the market because they can no longer afford to buy at these prices. So you have to wait till prices come down, and they're waiting. They're renting and they're waiting. And, they're trying to negotiate with sellers, and sellers don't want to come down in their price. And so you have this gap where sellers and buyers, there's no meeting of the minds between them, and the volume freezes up. So, that's very typical. The volume suddenly plunges. That's been a particular case right now in Vancouver. Prices are still way up, but the volume has just plunged, trade volume, and because the buyers and the sellers don't see eye to eye anymore. And buyers are worried about affordability, and they can't afford it, and they've been priced out of the market, and sellers don't want to face that reality. So they're not lowering prices to make deals. And for a while, you sort of have this uneven, market until something happens, and then something happens most of the time is that somebody has to sell, and they cut the price, and then they sell, and they discover, oh, you can sell this if you cut the price. And, then, you get the flow going again, but in these downturns, and the real estate moves so slowly. I mean, you think watching grass is is boring, and real estate it takes place over years. So, on a monthly basis, it jumps up and down, but in terms of overall movement, this is a matter of years and not of months. So it's a long time before anybody knows what the market is really, doing. But definitely higher mortgage rates entail price pressures, especially in markets with inflated home prices, and the first reaction is a decline in volume, and then the second reaction would be a decline in prices to get volume back up. The forced selling is what causes this. So if somebody wants to move or has to move and has to sell the house, and they can't sell it at the price they want, they're essentially forced to sell at whatever price they can get. That causes the shift in pricing. Until that kicks in, we won't really see much price declines, but eventually that will kick in. That's housing is not something that people can sit on forever. They do have to move, or they can't make the payment. The bank forces them to sell, those kind of things, and at that point you will see the volume pressures hitting prices.
What's happening with retail space?
In the United States, retail in general is pretty strong, and it's strong because online retail is absolutely booming, and because about half of the brick and mortar retail is not impacted by online retail. So that's gasoline stations, it's groceries, it's car dealers, and that amounts to about half of brick and mortar retail in the United States, and that still hasn't wandered off to the internet. So that part is doing pretty well. But the other half, and that's department stores, specialty apparel stores, teen fashion stores, those kind of things, they're under immense pressure from online retail. Department store sales peaked in 2001. And just imagine that. I mean, they're not adjusted for inflation or anything. It's just outright dollars. They peaked in 2001. They have been declining since 2001. And other stores, music stores have already disappeared essentially. Toy stores are disappearing. The photography stores, they're disappearing. So there's category after category of stores that are in the process of disappearing, and they're wondering, the sales are still there, but they're not in brick and mortar. Now they're wandering off to online retailers, and those are the retailers that are in shopping malls. Car dealers usually are not in shopping malls, and gas stations aren't either. They may be at the edge of it, but they're not inside. And grocery stores may anchor a mall, but a lot of times it's a department store that anchors malls. And so these malls that are anchored by department stores and that have all these other stores in the middle that are under pressure, these malls are in incredible trouble. And sales for them have been declining, and traffic has been declining. In the United States, we've built way too many malls in the last 15 years. And every time you build a new mall, you seal the fate of another mall. It's less than a zero-sum game because mall sales are declining. And so there's new malls being built on top of the ones that really aren't working anymore. So it is a very, very tough situation. So the vacancy rates, the official vacancy rates that we see are now shooting up. They've reached 8-9% now. But those are the official vacancy rates. What that means is these are vacant properties, where landlords are looking for tenants, for retail tenants. But once a zombie mall, for example, stops looking for retail tenants, and just shuts down, it disappears from the vacant inventory. So it's no longer part of the vacancy rate. It just gets pulled out. Same thing when the Toys R Us stores. Now, Toys R Us is liquidated now, and all the stores are closed. And as of Friday last week, and some of the stores are in good locations, and they'll find another tenant. And other stores are in locations where there won't be another tenant, and these stores won't be marketed to retail tenants. They'll be marketed to a developer for redevelopment. So they'll bulldoze the walls and do some different, or they convert them into restaurants or whatever. And so they're no longer retail properties, and they get pulled out of the vacancy data. And this is what's been happening for years. There's Sears closed a couple of thousand stores in the last few years. And these are big stores. They're 250,000, 300,000, 350,000 square feet each. And some of those stores, like the old Sears store in downtown Oakland, is an Art Deco building, and that is in the prime location. It was redeveloped into a cool office building, and Uber bought it, and then last year tried to sold it, because it's pulling in its horns. And so some of these buildings have easy alternative use, but others are just hopeless, and the only thing you can do is bulldoze them. And in any case, these disappear from the retail inventory, and they're being used, they're being converted to apartment complexes or something, and the landlords that own them, that now that mall is just worth the price of the land rather than a shopping mall. It's devastating, and it's no longer an income producing property. If it had a gas station on it, you may not even be able to sell it, because it's so expensive to remediate the soil contamination from an old gas station. And so this is happening across the country, and when you can no longer market it to retail tenants, you just don't you pull it out of the vacancy number, and so the vacancy rates, as high as they are, don't reflect the reality of what's going on in the mall sector. I'm sure there are malls out there that are doing really well, and they offer a great experience in the flagship malls, but then the B and C malls that are just really suffering, and they're shutting down, and they're essentially being abandoned, and unless they're in a location where you can redevelop them into a mixed-use complex, pull them down essentially, and build a new building, new building for apartments and offices, and at a very great expense, and the current owners, they don't get much for that. It's just the value of the land, and maybe less if it takes a lot of remediation. And that's the retail sector in the United States. The structural shift, it's not that new. It started, this department store started 20 years ago. This is a structural shift from brick and mortar to online. That's fairly gradual. It's booming, but it's fairly gradual, and it's only hitting part of the brick and mortar retail sector. It's not hitting all of it. It's only hitting about half. But that half that it is hitting really hard, and it will continue. I mean, it took 20 years to get this far. It will take another 20 years probably to complete the transition.
Should Canada welcome President Trump's idea of no tariffs, no barriers, no subsidies when Canada would get access to the U.S. market with 10 times the population?
Yeah, every country has its own favorite industries that it feels like it needs to protect. And so when the protections are lifted of this industry, the stakeholders in this industry raise a ruckus. And that's the same in Canada as in the United States. Some of those industries are inconsequential for the overall economy. The big example in the United States is the sugar industry. I mean, it's not like the United States sugar industry is important to the overall economy, but for the stakeholders, it's pretty important. And so, guess what? We protect this industry, and we have some of the highest sugar prices in the world. And Canada is doing the same thing on some of its industries. So, do we want to take all those protections off? As a country, does Canada really want to do that? The beneficiaries will be companies. That's the beneficiaries of all these things. The beneficiaries will not necessarily be the consumers and workers. The jobs may disappear. The prices don't necessarily come down. Companies will always charge the maximum price that the market will bear. They're not going to cut prices just because the costs go down. So there's a tendency for prices not to decline, even if we think they should. So I don't know what the beneficiaries would be. My alternate proposal actually would be for globally, for the whole entire world to get together and decide on a transporter tax on everything. Same amount by every country, and no other subsidies and no other tariffs, and this way local industries have a somewhat of an advantage over distant industries, and there's a little bit of protection, but it's equal. It's every country has the same level of protection, and the profit margins will shrink somewhat, but it's beneficial for local industries and for local jobs. And prices are set by competition, and they're set, they're always as high as they can possibly be. And so I don't think it will have a huge impact on pricing, but this level of no protection at all leads to to a world where companies just decide everything. And these are global players. They will go for cheap labor. They will go for the biggest tax benefits they can get, for the biggest tax subsidies. Right now, they're every major, whether it's Amazon or they're promising we're going to set up our headquarters in your city, depending on the package that you offer us. So they're shaking down governments with that. Nobody benefits from these deals except the companies. So I think there's a legitimate right of governments to protect to some extent their markets from these global corporations. And we have to be very careful with that. But these global corporations don't care about anything at all when it comes to labor or environmental standards or whatever. They go wherever it's cheapest. And then they'll use transportation to make that work globally, and that's not necessarily the best either, because you have all these the exhaust from the shipping and the pollution and all these things. So, yeah, it has caused all kinds of distortions, that, I don't know what the best solution is, but removing all protections, from all sides, is probably not the ideal. That's, if it allows companies to, without any kind of limitations, to constantly search for the cheapest labor and for the lowest environmental standards and for the biggest tax credits, then, it's really counterproductive, I think. And they need to be looked at very carefully. So, I mean, all these trade negotiations are very complex, and there's so many stakeholders involved. So I think, the trade relationship between Canada and the United States is really good. So it's not like we have a huge problem that we need to solve. And I wish we'd focus on some other issues, than that particular trade relationship. But I don't think the solution will be to reduce all protections to zero.
Wolf, what do you see ahead for the U.S. dollar?
Well, I think it's going to end up the year, higher. It had a terrible 2017, and the Fed is tightening. The Fed is unwinding its QE. These are things that are supportive of the dollar. Raising interest rates is that's making dollar-denominated investments more attractive, particularly fixed income investments. So that should create demand for those in half. So the dollar's gone up quite a bit this year. There's natural limitations to how far that can go, because when the dollar gets too expensive, then it starts hurting the economy in the United States and causes all kinds of mayhem elsewhere. But I think at this point, so far this year, and going further towards the end of the year, I think the dollar will be on the stronger side rather than on the weaker side.
Wolf, how can people find out more about Wolf Street?
wolfstreet.com. It's a free website, so everything is free, and we'd love to have you check it out.
Wolf, thanks a lot for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Rick Ruhle and Wolf Richter. And thank you for listening. If you have any questions or suggestions for the show, you can send them to info@howstreet.com. I'm Jim Goddard. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. My guest is Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Always glad to be on the show, Jim.
Larry, last week you were in Las Vegas at the Battery Show. Have you had any reaction to your presentations yet?
Well, I certainly, as I mentioned last week, I had some great meetings down there. We got a good reception. There was a great crowd of about 300 people attending the show, which is one of the bigger crowds that I've seen. And again, most of our interest, or 90% of it, came from the Chinese groups. But we did come back to Vancouver, and I had another meeting with a big private firm out of Germany. It's been around for 150 years, a multi-billion euro a year company, and they were quite interested in our process. And we had that meeting yesterday down at the Chemetco office, where they could see how we were proceeding with our IPs and parts that were coming in for the pilot plant. And it was going to be a 2-hour meeting, and ended up to be a 3-hour meeting. So when they go longer, you know that the interest is there. And but again, I don't expect to hear back from them for probably up to a couple of months. They've got to talk to their board and everything else, and they are a private company, and they just took over a 50% interest in a battery manufacturer in the U.S. So they're in the right area. But that said and done, as I may have mentioned last week, the theme was about reuse. And I've been doing a lot of thinking about that, and that is something that's being bandied around in the press here in North America and Europe. Reuse sets out the recycling responsibilities for several more years, and but it doesn't solve the problem of the cathode material that you need for the batteries. And I think reuse is just a knee-jerk reaction to, getting the regulatory bodies off your back. China has come out with regulations now, and certainly any meetings I've had with battery manufacturers out of China or Japan or Korea, for that matter, don't talk about reuse. As a matter of fact, one of the themes that they talk about with us is would be, and that's from two different companies, from two different nations there, and that is, would we be interested in starting off with them stockpiling lithium-ion batteries for the recycling? Well, that is an interesting aspect. It's certainly different than what I've been getting from our U.S. or Canadian or European folk. They don't talk about stockpiling any batteries. I know that people talk about where are your batteries coming from. Well, that would be an answer. And I haven't moved on that yet because that's just a little bit premature, because those batteries would sit there for up to 2 years before they would ever be needed to go through a recycling process. So, and those batteries are hazardous. So you don't want to have them stockpiled around in a yard or in a building or anything like that, because, they can short out, and the next thing you know, you got a fire that's belching out all kinds of contaminants in the air. So, but that is an interesting aspect that I will be pursuing. And but reuse, I don't see it as being a long-term solution. I see that being this very stopgap solution when you would want to put thousands of dollars worth of cobalt and lithium on the wall, when you could be replacing that with manganese and lithium. But it does answer the question when you're under the gun. There's not many solutions out there when it comes to recycling. Ours is probably the most transparent out there. People can actually follow that. They can go to the site and connect into the U.S. Patent Office site and have a look at our patent. And so they know that what we say is irrefutable. We get what we get. So I don't see reuse as being a big issue. And the other thing is about the building batteries, cheaper, getting rid of the cobalt out of it. And again, that is not a long-term solution. I'll give you an example. When you make a nickel manganese cobalt battery, NMC, the higher the amount of cobalt in the 111 chemistry, you have a longevity of 95% and a thermal stability of close to 315. And then as you move down to the 622, the thermal stability and the capacity retention goes down. And but as you go down to the 622, you have a thermal stability of around 275 and a longevity of under 90. And then the 811, you're down to 80% on the longevity, and your thermal stability goes down to about 240. That's not what you want. You know, Elon Musk's chemistries have allowed him to, have a real startling power ratio where he could go from 0 to 60 in mere fractions or seconds and fractions of seconds. And you're going to lose that if you don't have the cobalt. So whether he moves away from cobalt or not, I think the Asian market is not looking at that. That's the biggest market out there. That's where the biggest interest comes from, because they do have laws that are coming in and will be enforced very soon. That's why there's a big interest from Asia. And I hate to say it, but we're lagging here in North America. And Europe is doing something to catch up, but it's lagging too. So, am I concerned about it? When we first started on this program, and when we first started on our proof of concept, the price of cobalt was $10,000 a ton. Today it's down to $72,000 a ton from up over 90. And but that again is not a long-term situation, because cobalt is scarce. And you're also got copper below $3 and nickel dropping. Everything else, zinc, lead, they're all dropping. And this has got to do with the trade tariffs. I think that when Trump comes through with his ultimate plan on that, and there will be meetings of the mind, everything will get back on track. The thing that really excites me is, we had a tough day in the market today, and it traded just under 600,000 between the U.S. and Canada, and it was down pretty early in the morning, and it ended up at 17 cents. And you look at the trades and you see, wow, how Anonymous sold half of the stock today. Well, there's a lot of predator trading and a rearranging of the books. It's just after month end, and so they got to balance out their accounts. I think that really, if a full investigation was done, you'd find there was no change of ownership, which is wash trades. But that's just my thoughts. And but in the meantime, it makes the company look weak. But we're in good company. There's good companies out there that are also getting thrashed about, and a lot of anonymous and jitney trades on them, and they go through Scotia and all the other firms out there. You can jitney your stock through any firm out there. But I think that we're in the right track. I think we're in the right field. I think that we're probably recession-proof. I think this electric vehicle situation is going to take off. There's enough batteries out there now that have already been produced with high cobalt numbers in them that would keep us going for years. And that's what people have to look at. There'll be a lot of things tried to circumvent the shortage of cobalt and the price of cobalt, but I can imagine right now that the Asians are lapping up all that cheap cobalt at $70,000 or $72,000 a ton. And in the meantime, I think that we're in a good position. We're in a very good position. The stock has been held in a narrow range, and which means that people can, new investors can load up at very, what I would consider, bargain prices.
Larry, where is American Manganese traded, and how can people get more information?
American Manganese is traded on the Toronto Stock Exchange Venture Exchange under the symbol AMY. It's traded in the U.S. under the symbol AMYZF. And it's traded in Frankfurt under the symbol 2AM. We have a website out there that has all our information, and that website is AmericanManganeseInc.com. You can phone the office here at 778-574-4444, or you can email me at REAUGH@AMYMN.com.
Larry, thanks for the update.
You're welcome, Jim.
We've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on July 5th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.